Well, welcome back to You Heard It From a CFP. My name is Matthew Coyle. Nice to be back. Today we're talking about retirement assets and how to allocate them for best long-term success. Let's dive in. Okay, retirement assets. How do you allocate them for your best odds of long-term success? Now, I get this question all the time. In addition to doing cash flow planning for folks or answering questions about general tax advice or general financial planning questions, the question we get probably the most often is, where do I put my money? What do I allocate to? I can't tell you exactly what's going to happen in the future. Nobody can. If they do, they're probably lying to you. But what I can tell you is where I think your best odds of success are. And to that, we look at history and decide, well, what's likely to change, what's not likely to change. Let's look at some data. First, we're going to start off with 2013 forward. Then we're going to go from 2002 forward, I believe it is. And then we'll go from 1995 forward. So we get a nice long look at what has actually done the best if you're deciding how to allocate retirement assets. Let's say you don't need in the next 5 to 7 years. And of course, cash and short-term savings bonds, personal real estate, things like that just aren't going to get you there. So you have to make the decision, where do we go with our money? And I run into far too many people who are, I think, a little bit too risk averse when it comes to this stuff, and they need to take a little bit more risk. And I think this data will show you that even in good times and in bad, and we've experienced a lot of good times and bad, you know, just how it is. But through the good and through the bad, being a market investor both in the US and abroad has been a pretty good proposition. So let's look at some data here. We'll start off with BlackRock. And this data comes from BlackRock. 2013 to 2022, on the right-hand side of this chart, you will see an annualized number. U.S. equities coming in first at just a shade under 15% over that time frame, roughly an 8-year time frame. Professionally managed REITs, now that's professional REITs, real estate investment trust, not your home, but professionally managed REITs came in second. Infrastructure, European equities, Japan equities, high yield bonds, you can go all the way down the list to commodities being basically a break even. So that's, generally speaking, the categories that have done very well since 2013 forward. If we break that down even further, we can get some data from MFS and look more specifically inside those asset classes from 2002 forward, which is an interesting data point. So generally speaking, large cap US equities over the past 8 or 9 years, let's say 7 to 9 years, have been a very good place to be. Small cap equities have also been a very good place to be. Let's look at MFS's data. This comes from MFS here, and we'll go from 2002 forward. Now from 2002 forward, we see a very similar pattern, but we can break it down a little bit more granularly. Large cap growth, again, we're on the right-hand side of the screen here. Large cap growth, 10.8%, a little under 11%, has been a reasonable return since to expect on a high-performing asset since 2002. There's REITs again, that's professionally managed real estate, not your home, professionally managed real estate. Small and mid cap has been very close to large cap growth. Large cap value has also done reasonably well. A diversified portfolio, which is generally considered to be a 60-40 return or 60-40 blend, a shade under 8%, and you go down the list: international, global bonds, general bond, commodities, and cash. Cash, of course, being the unsurprisingly, it's the worst place to be. It really doesn't yield much. Doesn't even keep pace with inflation, actually. So, post 1995, if we back out even further, what does the picture look like? Okay, so let's go ahead and look at that right now. So we will take the annualized return versus the average rank of assets since 1995 and look at what the best and worst places to be were. Now here we see a very similar message again, okay? This particular chart is comparing the annualized return of the asset class, generally speaking, and this is very broad asset classes. We're not getting as granular as the MFS data. But the rank compared to the annualized return. So the rank, the lower the number, the higher the rank. So you want, on this chart, you want to be lower and to the right, and the worst places to be were upper and to the left, because you had a higher rank, you know, corresponding with a higher number and a lower return. So you want to be lower right in this chart. We see a very, very similar picture here again, backing up the data. This data actually comes from a different source. It comes from ETF Trends, which is a different website. But in this case, again, we see it again. Small, mid-cap, and large-cap U.S. equities, and value sneaks in there too. Bonds and gold, things like high yield bonds right in the middle there. Foreign stocks have definitely underperformed. That might change in the future. It might, we could talk about that for a second. And then finally in the upper left, the worst places to be cash and personal real estate. Now in this chart, real estate refers to your personal home. It does not refer to commercially managed properties. This is personal real estate in that chart, okay? So cash and real estate really, historically, they've always been the worst places to be, especially your personal property. And we see that in the data from 95 forward. So if you're allocating a retirement account, the decision you have to make, does recent history, is that likely to repeat, or is everything going to be different? And you'd have to be making a pretty big asset allocation call to say that things are going to be dramatically different over the next 20 years than they were from the previous 25, right? So we still continue to allocate most of our clients' assets to US-based equities over foreign equities. We don't tend to favor foreign equities. We try to keep cash to an absolute minimum in portfolios because you don't want to have too much cash on hands. Most advisors start to twitch if they see too much cash in a portfolio. They want to keep that cash invested. And we don't put a heavy emphasis on commodities or gold simply because it just hasn't seen the same return profile over the long term that US equities or small cap, mid, large and small cap equities have seen. So specifically, if you want to get really into the data, small and mid cap has tended to be the best place to be. Large cap has tended to be the best place to be, and then from then it trickles on down on the return profile. The real question is that expected to change, and why would it change? All right, a couple things going forward, and I will conclude. First off, making these decisions to allocate your retirement funds is a very personal decision. It's based on your spending habits, what you think you're going to need in the future, and of course how much risk you're willing to take. So if you're working with a planner or advisor, or if you're doing it yourself, it's a good discussion to have with them or yourself, and just look at some statistical reason for why you want to invest the way you do, and then do it. The other thing I would tell you going forward is it's very difficult to predict which asset classes are going to be winners in a given year. If you can look at that MFS data chart that I showed you with, from 2002 forward, and think you are going to be able to pick the winner every single year by moving into cash, back into that class, then out of that, then into another class, just back and forth across the side of the boat. Boy, I wish you the best of luck, but I don't think I could probably do that. That's number one on that. And number two on that is that this is why we build long-term diversified portfolios that stand the test of time. And we do it within the best cost parameters that we have and within the best funds that we feel are appropriate within each class. So build a long-term broad-based portfolio. It's going to serve you well. Make sure all your cash is invested. Cash is a terrible place to be, despite the fact it might make you feel better. It is historically a terrible place to be. Keep yourself invested, keep saving, keep it pointed forward, and I will see you next time. Thanks for watching. Good luck. Bye.